Hello, everyone, and welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, your host for this week, with my friend and colleague Quincy Crosby. It is March 13th, 2023, as we are recording this. Quincy, thanks for joining today. How are you?
Yeah. Good, thank you. Appreciate it.
Yeah, it's a tough day, certainly. Late last week was tough for all of us following the markets closely. So I think job number one for us today is going to be to try to help make sense of the Silicon Valley Bank failure. Why did it happen? What does it mean? I think this first bullet point here, you see risk of contagion. This is really the question people are asking most today. But we'll also talk about how this is different than 2008, and then highlight some opportunities, plus some risks. But really, we think based on where the banks are selling off, are selling at now, at least some of these more diversified banks, the banks with better balance sheets, certainly than some of the banks that have failed have, obviously, there may be some opportunities. So we'll talk a little bit about that too. And then the weekly market commentary for this week is on just an update on asset allocation. So we've got a few charts we'll run through really quickly on that. You can find the weekly market commentary on LPL.com. And then lastly, we will preview the week's data. And actually, people aren't going to be paying close attention to it, but there's actually a lot of very important data. So we'll get to that at the end. Let's talk Silicon Valley Bank, Quincy. So maybe I'll start by just sort of framing what happened really high level, and then I'll let you talk about some of the implications here and whether we are at risk of contagion. So some things make Silicon Valley Bank unique. They were put into receivership on Friday because the capital position eroded so significantly. A few things happened, right? We had a run on deposits. They have a very concentrated customer base, a lot of venture-funded startups. And those deposits weren't very sticky, and word traveled fast that the bank was in trouble. So essentially $40 billion plus left the bank within hours, very, very quickly, something I don't think we've ever seen before. So that was a big problem, of course. But the other piece of this was their balance sheet, right? They weren't reserved against that deposit flight because they had so many interest rate sensitive treasuries, right? Long duration treasuries. And when they had to mark those to market and take those losses on their balance sheet, coupled with the deposit flight, they were at the point where they couldn't continue as a going concern, right? So it really took those things together, mismanaging the interest rate sensitivity of their balance sheet, coupled with the deposit flight, which was really made possible by their niche client base, in the sort of startup tech and startup biotech universe. So that's really what happened. So Quincy, let me turn to you. Why is this situation different, and is there, than what we've experienced maybe in 2008, and what do you see as the risk of contagion?
Well, first of all, contagion really is a function of fear. It's a function of just panic. That's what leads to contagion. And the next thing you know, folks are saying, well, what about my bank? And then they create a run on their banks. What the Fed is trying to do, or the Fed and the FDIC and Treasury Department all working together, is to quell that sense of fear. And they did it rather quickly, actually. First of all, they tried to sell the bank. It didn't work. They had PNC, I think they were talking to PNC, didn't happen, nothing happened. So the next thing you know, you get a statement that the deposit, those who have deposits under $250,000, of course, they are insured. They would be safe. And then it was also added that even those who have more than $250,000, which many of the depositors were in that category, they would be safe too, but the shareholders, no. In any case, the idea was not right now, they weren't worried about the bank. They were worried about a run on other banks. So it was interesting that the market was waiting for even more. But what happened and why this is different than 2008 is that was a function of the subprime mortgages, that all of the banks, portfolio managers had them in their portfolios. And the reason was they gave you extra yield. It was a period in which yields were kind of, just very quiet. And there was an ability to take those subprime mortgages, package them, and then lever them up. And it was the leverage that was associated with them that really just destroyed as many banks as you can imagine. We all know what happened. And that was the issue. We don't have that here. We don't have that. That it's a different scenario. However, you know the expression, Jeff, when Fed raises rates, something always breaks. And this was it. This was it. This was it. Now, I mean, it isn't even as if the Fed has raised rates that much, but there was no risk management here. And so the question is it isolated? The question is really, in the regional banks, how many of them actually have good risk management? How many of them think about how they would get through during a period of stress? The large banks have been tested, tremendous amount of regulation, and they also, have gone through the stress tests. This bank in particular actually did not have that. Apparently, they negotiated something with the regulators and felt that they didn't need it. But overall, there was no risk management. Taking a look at the documents, it was fascinating. Risk came up so often, but there was really no one really doing any work. The board looking at the backgrounds, very impressive backgrounds, but nothing associated with risk management. And so they managed to get through this period until now. And, because of, you just mentioned it, the nature of their clientele also being hindered by the slowdown in IPOs for technology, slowdown in secondary offerings and deal making. They heard rumors that there were issues, and they knew that they needed to get their money out. The question really is now, actually, whether or not confidence can be restored. If you don't have the confidence, you're going to have more contagion because you're going to have panic. You see it in the Treasury market. There's been a push towards safety. What was interesting in today's market was the ETFs were down. Even the large cap ETF was down. That was the XLF. And the rest of the market was up for a good portion of the day. It was up. Everything was in the green. Now, you tell me how you could go on and have a scenario in which the banks in America are down in share price and the rest of the market is up. The juxtaposition, when you look at it, like something's wrong with this picture. You got to have the banks. You've got to have the banks working. You've got to have the banks functioning and confidence in the banks. And we have to see if the Fed can do this. But again, the market believed that they came into this notion that the Fed no way was going to raise rates in March. And that, that sort of assuaged fears in the rest of the market. But, there's a call right now that the Fed needs to raise rates just to, especially if the CPI and the PPI reports, consumer price index and producer price index reports are showing that inflation is still hot. Mm-hmm. So the Fed's in a difficult position.
I've never seen so much disagreement about what the Fed's going to do next than I'm seeing now.
Exactly.
Right.
Exactly.
Some are saying
exactly.
Some are saying cut next week after we just debated last week 50 or 25.
Yes.
And the voracious demand for treasuries in the last 4 days is dizzying. I mean, right? I mean, we took 100 basis points off the 2-year yield in a very short period of time, which is one of the biggest moves you've ever seen in that. And then the 10-year yield, of course, down about 0.5%, but essentially from 4 to 3.5, just like that. So just a huge unwinding of expectations for the Fed. That's kind of the silver lining here, Quincy.
Yes,
and
exactly.
You brought up a lot of good points about what makes this kind of different. And there is still risk of contagion because you're right that confidence is everything in banks, and people are free to move deposits. And the banks have a lot of losses in these bond securities and these treasury securities on their balance sheet still. In fact, if you chart, I'm sure somebody's put this chart out, but if you chart unrealized losses in securities portfolios for banks against their stock performance today and maybe Friday, I bet there's a near perfect correlation, right? The most interest rate sensitive and lowest quality balance sheets are seeing the biggest sell-offs today. I'm talking about the regional banks. So that is what people should be, if you're trading individual banks, that's what you should be watching. I think on the other end of this kind of gets to the opportunities piece in the agenda on the previous slide. There's going to be a really attractive opportunity here to make some money in some of the, we'll call it higher quality regional banks or higher quality super regional banks, right? Because they're just selling off. I mean, these valuations, sometimes you don't even see these valuations in a crisis. We're even below some crisis level valuations in some of these cases. And so I don't know what's going to cause confidence to be restored in this group. I don't know what more the Fed can do. We're probably going to get more regulation. They're not going to have a situation where a bank of Silicon Valley's size does not undergo stress test. That's a kind of an easy thing to change. But the Fed can't guarantee deposits for all these banks, right? There's just not. I mean, it would come from the taxpayer, right? And there's no appetite for that kind of bailout if some of these super regional banks see a run like what Silicon Valley Bank did, and we should mention Signature Bank of New York, which also failed over the weekend. So something will come to restore confidence, I'm sure, somehow, but it's just not clear, Quincy, how that happens. Is there anything regulators can do?
I'm sorry?
Is there anything regulators can do to quickly restore confidence in all of these banks, short of guaranteeing all deposits, which obviously is an expensive proposition and not workable?
It is expensive, but obviously the Fed felt that, you had those facilities allowing them to borrow at a low rate, which is really interesting because this is exactly what the Chinese People's Bank of China is doing with the failed property market, coming in with these facilities of very low rates to help get them through. They've got to do more of that. They're probably going to have to do more of that. We haven't heard the end of it in terms of what they're going to do. But above all else, it is about those with deposits. And you're right. And this is where the question comes in, Jeff, is, well, if the government is going to take care of me and I'm above $250,000, well, maybe I'll just stay with my bank. I won't call up and start taking the money out and divvying it up, $250 and $250 for other banks. However, a little voice in you says, just what you alluded to, are they really going to be able to do that? Are they really? And then once you start going down that path, you start thinking, I better get my money out. And that's where they do not want to see that next thought come into your brain, because that is where the contagion is. That's where the panic is. And sometimes these things are irrational. Sometimes it does. You can't stop it. And as you pointed out, how quickly this happened, correct? How quickly it happened. Unbelievable. I mean, Washington Mutual, if I'm not mistaken, it took a while. I remember it was in the news for a while. It was wasn't it a slow death?
I think so. Sure.
Yeah.
Well,
yeah.
because banking wasn't so digital back then, it took longer for people to get the word that there was trouble and move their money. That now, people don't have to walk into a branch.
Yeah.
Some do, but mostly this was just, again, the uniqueness of the client base. These VCs. This was basically like a VC network. Their client base.
Yes.
And so word traveled like wildfire, and people were just clicking transfer. Right?
Yes.
It didn't take that long. It didn't take
exactly.
that long.
But
right.
I had a couple of things positive. This is positive. The HSBC bought or said they're going to buy the British branch of SVB Bank. So that's good, because otherwise it was going to be put down in the junk category by the British government. So they're going to buy that. If we could find a buyer, if they can go out and find a buyer, that would be helpful. That would, I think, restore confidence. I was thinking to myself, because you remember Warren Buffett, every time he kind of drops into scenarios like this, granted, he always gets a very good deal when he comes in as the savior. You remember?
Mm-hmm.
That helps restore. It does. It helps restore confidence. Something along those lines. I mean, you need to have a buyer. You need to have a buyer. And they failed. And then the next thing was, okay, we're going to take care of the those who have deposits, not the shareholders. No, not even some of those who hold debt. No, but we'll do that. And you have to ask yourself, what would have happened without that? What would we be looking at today if they had not said that about making that?
That's the decision that the regulators made. Invest a little bit now, right, and stop the contagion, or wait. Avoid the political fallout, because people are saying this is a bailout, which it really isn't.
It isn't, no.
So and pay a bigger price later. So I think they made the right decision in this case. But once you start introducing taxpayer money, this is not a taxpayer bailout. FDIC is paying the bill. But once you get into taxpayer money, that is a whole different story.
Oh yeah, yeah.
And then
absolutely,
that's where you have trouble. So there is contagion risk here. Maybe it's low, because the Fed is backstopping deposits and opening up the discount window and making it easier to borrow against devalued securities and all of that. But if we do get to a point where you have some other big troubled banks, there's going to be some depositors could end up losing. I guess we don't want to sugarcoat this. There is certainly a possibility, if we get more runs and more troubled banks, that uninsured deposits will be at risk. So take that for what it's worth. It's a very uncomfortable situation to be in, but that's what we're dealing with now. If confidence can be restored, which is likely to happen in the coming months, hopefully coming weeks, then you have some real opportunities. I mentioned it earlier. You could have an opportunity to buy some of these higher quality banks at really attractive valuations. So that's not an opportunity now in our view. We just discussed this at our asset allocation committee meeting just a couple hours ago. And preferreds came up as a topic of conversation, as a potential opportunity. So it's a little bit of a higher quality way to buy banks, maybe not as high quality as an investment grade bond in a bank, but a pretty high quality way to invest in financials. Most preferred securities are financials. So that's another place to look potentially to take advantage of this downdraft, but we're really, in general, we would wait for the dust to settle a little bit. So that's a quick look at the opportunities and the risks. Anything else on this, Quincy, before we move on? I mean, that's a lot. Probably didn't inspire a lot of confidence, but it's still early and the situation's fluid, so we really don't quite have the resolution that we want.
No,
Although it's good that, as you mentioned, that the rest of the market, I mean, I'll have to check again, but it's changing every second. The volatility in futures, volatility in futures overnight was crazy. But we've been kind of bouncing around, up a little, down a little, most of the day. Looks like the broad market is kind of flattish right now, but we're seeing some gains in the NASDAQ.
Yeah, exactly. Yields are coming down, and that's always been attractive for tech. And there's a view somehow again that if the Fed doesn't raise rates, it's indicative of their fear, and which then, of course, you analyze, and then that would bring rates down even more, which is also attractive for the longer duration tech names. So this gets into a psychological. It has nothing to do with fundamentals anymore. It has to do with the psyche of the Fed versus what the market wants.
No doubt. Yeah. So they might just raise 25 basis points to show their conviction in taming inflation and to project confidence that the banking system can handle it. However, there's some really smart, widely respected Fed watchers out there who say they're going to pause because, if they don't, they're kind of on both sides of the trade, right? Causing bond losses and, in a sense, so the narrative goes, bailing out the losers from those bond losses that they are creating. So it's really, they're in a tough spot. I wouldn't be surprised by a pause, but I think the odds slightly favor that projecting confidence, continuing with their plan and going ahead and hiking 25 basis points, but being very cautious with their message as they do that.
Do that, Jeff, but what about one other thing? What about pausing on the quantitative tightening aspect, which you don't hear much about, but that they pause. So they raised 25 basis points and then they said, we will pause. That would not, I think, have the market as concerned if they said, oh, we can't raise any rates because things are really that bad. That would make the market nervous. But what about, would there be that much of an effect in the market if, in fact, they said we're pausing with the quantitative tightening? What do you think?
I don't know the numbers are pretty big, but you're right. Yeah. The market's not really paying close attention to that. And it's kind of hard to quantify exactly what that impact would be. But when you see rates moving 50 basis points in a couple of days, right? That really, I think, is almost overwhelming.
Yeah.
Any impact of the Fed being out there, either not selling or buying treasuries in a sort of methodical, right?
Mechanical
sort of small amounts over time, regular small. So it's a really interesting question. I wouldn't be surprised by that either. I think that they're going to want to be very careful, and this is new information they didn't have when they were talking. I mean, even when Powell last week was testifying in front of Congress, he didn't have this information.
No.
So obviously, he would have talked much differently.
Yeah,
so,
exactly. Yeah.
This is, as I said, a very fluid situation, and I can see strong cases on both sides for the quantitative tightening, not selling bonds potentially, or the 25 basis points up or pause. It's a tough call. Boy, I tell you, I knew Chair Powell had a tough job, but now he really has a tough job. So let's move on, Quincy, and just talk about some of the other topics that we have here.
Sure.
So, well, first, to wrap up this topic, credit default swap. So this is just insurance against bank defaults. This is the whole group of banks aggregated together, a chart created by our chief technician, Adam Turnquist. And the point here is that the the market's bet on broad defaults in the banking system haven't even come back to where they were a few months ago, right? Forget about 2008 comparisons. We're not even to the October lows of 2022, right? Remember, the stock market bottomed in October of last year, and that was the point where sort of you had this, ratcheting higher of Fed rate hike expectations and disappointing inflation numbers and all of that. And yet bank failures were just not really on the radar for anybody. But credit default swaps were pricing in a greater chance of default then than they are now. So this is a positive message. This is a pretty calm message. Now, these spreads are probably going to widen. It's when you're buying insurance, when your house is on fire, the insurance rates go up, right? So that's essentially what this is. Some of the banks are on fire, and insurance is going to cost more. So you're going to see this move up probably in the coming days. But if it stabilizes somewhere near where it has been, that'll be certainly a positive sign. And we would think it would. What you have here is a kind of a barbell, right? You have some really high quality banks that are doing fine, and then you have some banks that are really getting hit hard today because the market is looking at balance sheet risk and saying that those banks are in worse shape and might be at risk of a run, might be at risk of needing capital, right? So the high quality ones go up and the low quality ones go down, and you end up with a little bit of a deterioration here, but probably not dramatic. We'll keep watching this, but it looks pretty good now. So it almost seems like a year ago, but last week, just to highlight a couple of things as we transition to asset allocation. We've basically had a 5% pullback on just this bank news alone. And small caps got hit a lot worse, right? Small cap benchmarks have more financials in them. They have more banks in them. And so it's natural that those would do worse. Plus they're more credit sensitive, right? They have generally more debt on the balance sheets, rely on the capital markets more, or just traditional bank loans for funding. And as credit markets deteriorate, you tend to see small caps underperform. So we mentioned, preferred's maybe a situation where you can get a good deal buying them here. Regional banks, the better regional banks, we think a good deal coming soon. Small caps would be another one, right? Small caps are getting absolutely hammered the past few days. Maybe an opportunity here. I think that's really all. Anything to add to this?
No, it's just been difficult. We did see industrials hold up. They managed to hold up, but the worry, Jeff, is if we get another bank, I know First Republic, but and then if we get another, is that the psyche in the market just how do I say this? Is you get a vortex of uncertainty, and that's the last thing you want because it will envelop everything. That's the worry, except treasuries, obviously, in gold, complete risk off, which of course then provides tremendous opportunity. I had a question for you, Jeff. With rates coming down, if it continues, do you think that folks will be, how do I say this, refinancing? Do you think that they will be going out, as we've seen before when rates have come down, actually take advantage of lower house prices and buy and go house shopping?
Sure, absolutely. On the margin, you're going to see more of that.
Yeah.
It doesn't make a lot of sense, but you've even seen refinancings in the last few months, right? They don't go to zero. I guess, this is a huge move, right? We're talking about mortgage rates probably going from, 7 to 5.5.
Exactly.
Potentially. That is a huge move. I don't know where they are today, but that's going to make affordability a little bit more attractive for people. The other thing you're seeing a weaker dollar, and that's falling interest rates helping gold. So gold appears, at least for now, and we've liked precious metals, positive view on precious metals recently, as well as industrial metals. Gold likes a falling dollar. Gold likes lower interest rates. Gold likes kind of this crisis mode where you're relying on the government stimulus or government
Mhm. Right.
regulation, right, to kind of keep us afloat. This is so that may be an opportunity and an interesting hedge for people who maybe are looking to be a little bit more defensive in the short term. In fact, I'd probably rather be there. I mean, utilities are fine as a defensive play, but I'd probably rather be in gold for the very short term while this settles out than utilities with some equity sensitivity. So here's, precious metals haven't been doing great. But last week kind of flat. That's a win, right? When the stock market's down almost 5%. So, but really just turning to the left-hand side of this table, look at the bond rally last week, right? Treasury index up 1.6%. Like, I mean, that's a year for bonds in some cases, right?
Yeah.
So I can't I mean, we'll, we want to hear from Lawrence Gillum, our fixed income strategist on this. He obviously is much more qualified than I am to talk about the magnitude of the bond move. But this was just massive. And I think it's only a handful of days where we've seen moves or 2-day or 3-day periods where we've seen moves this big. I think 1987 was really the only time we've seen.
Oh my goodness. Yeah.
Yeah, we know what happened in 1987. So you got to go back a long ways to find a move this violent in terms of yields falling. So here's what the S&P looked like at least a few hours ago. I think we closed similar to this, kind of 3880, 3890 range. So we're below the 200-day and the 50-day. People are paying a lot of attention to the 200-day. So that break is certainly negative. So this is, introducing the risk of 3,800, maybe even the October lows. Much more likely that we go down there and retest. We don't have a lot of conviction that we're going to hit the October lows, but certainly, given this environment, given the risk to the economy and earnings over the next few months from this crisis, it's going to be, a little bit tougher to just get back to, let's say, 4,300, which is our price target for year end. But we had anticipated making a run at that more quickly. Now it's just going to take more time as we kind of digest what's just happened in the banks. So I'll run through these real quick. The charts in the week of market commentary, where we just update our thoughts on asset allocation. This is growth value, and I was surprised that on a technical basis that growth didn't quite make enough progress to flip this and kind of turn into a technical buy. So Adam still sees value as having a slight advantage, but of course that is very reliant on what we see out of the financials. So I wouldn't be surprised if this flips and technically growth looks better, but it just hasn't quite yet. So turning to small caps, I mentioned the valuations. Here you see them, 13 times forward earnings for the S&P 600 index. That is really, really cheap. And, we would continue to favor that index over the lower quality Russell 2000. But I mean, just so much cheaper than its average and so much cheaper than large caps. We continue to think small caps are an opportunity. Now, remember, you have more financials there. Right, much higher weighting in financials. So relying on return of confidence in the banking system to really work, but that's an area that we continue to like. And then I got two charts on international. So first, this is just earnings growth consensus for international versus EM versus US, and you can see US and developed international consensus is still up about 2 points for this year. Those estimates are probably too high. We might have a slight decline when all the numbers are in. We'll see. We're forecasting flat. But what's interesting is, developed international is in line, right? So the U.S. has had an earnings advantage for so long. This year they may not. Certainly Europe's gotten a lot of help. Quincy, you and I have talked a lot about this because of lower natural gas prices. The resilience of the European economy has really helped kind of level the playing field. So developed international looks cheap relative to the US. The technicals look better. And the earnings picture is similar, right? So frankly, we're pretty much almost indifferent between those two. We do have a slight overweight to US relative to developed international, but not as significant as it was before. And we continue to underweight emerging markets, which are expecting to see an earnings decline this year in consensus. So the earnings decline with the strength of the dollar year over year, maybe this earnings decline is even worse. And then last thing on this, Quincy, and then I'll turn it over to you for any comments on any of these points. The earnings estimate momentum for EM is pretty bad. That's the light blue line at the bottom here. It makes sense after the Russian invasion of Ukraine that those and Russia's removal from the index that you would have negative, estimates be cut, right? Which we got. But look what's happened, even in just the last 6-7 months. Estimates have continued to fall. So some of that is currency, but it's not all currency. So we just think it makes sense to be careful with emerging markets because of the estimate, the negative estimate revisions, expected earnings declines this year. Plus, EM doesn't have a great track record of hitting earnings estimates anyway. And then you have the China tensions, the ongoing conflict in Europe. It's a tough environment for EM. So we continue to recommend an underweight, which we talk about in the weekly commentary. So that was a lot. Anything to add to that, Quincy, before we quickly look at the data for the week and wrap?
No, that's good. It's all good.
Keep rolling?
Yeah, keep rolling.
All right, let's keep rolling. So we got a ton of data this week. Nobody's going to care about economic data too much tomorrow or Wednesday, maybe. But well, as you're listening to this, it's Tuesday. But if the CPI is off of expectations in either direction, then maybe that will get some attention. What are your thoughts on the inflation data for the week, Quincy, and what else should people be watching?
Well, the inflation, the Fed still has a job to do. And again, I as you pointed out, it's a conundrum for them, isn't it? And I think they'll be lucky if it's a little bit cooler, just as the payroll data actually was a bit cooler despite the headline number. So if the data are cooler in terms of inflation, I think it helps them. Obviously it helps the market, but for other reasons. The Fed doesn't have to prove anything in terms of their commitment. So maybe they do stick with the 25 basis points. By the way, I think too, if the Fed takes a look at the data and the market and the financials, we will know. I don't think they're going to surprise the market on the 22nd. I think they will telegraph it with the statement before they're in the blackout period, right? But I don't think that they want to surprise the market. Certainly would not want to surprise the market with 50 basis points. Absolutely not. But 25, or if they don't do anything, sometimes they get more bang for their buck in the market when they do something that the market wants. But this time it's different, Jeff. I think the market wants them to do their job and get rid of the inflation and just do it and finish up the job. I think ultimately the market would be disappointed if the Fed stopped or paused.
Yeah, I think it should be clear to the market that the problems at Silicon Valley Bank are not going to cure the inflation issues, right?
Right. Yeah.
Even if it creates a tougher environment for venture capital funding and some of those startups, that's not enough to bring down CPI over the next few months, right?
Yeah.
It's really so. It's enough to get Powell to pause because he doesn't want to create any more bank balance sheet problems.
Yeah.
Maybe after this March hike, or be very careful with his comments if he does hike in March on the 22nd. But it's it's not going to make a meaningful dent in inflation, right?
No.
Now,
No.
the hikes they've done to this point are going to make a little bit of a dent in inflation,
Mhm.
right?
Yeah.
And certainly, you know, consumers have seen purchasing power eroded and are being a little bit more cautious. We saw unemployment tick up a little bit, at least based on the unemployment rate. So you're going to see consumers be a little bit more cautious, a little more discerning, right?
Mhm.
And maybe that makes it tougher for companies to pass through higher prices.
Mhm.
So there's no doubt that there have been some moves, some advertent, some inadvertent, right? Some things that have helped contain inflation and get it, off the boil. But
Yes.
this latest news probably won't have a huge impact because we're just not talking about enough people and enough jobs to move the needle quickly. It's more about bank balance sheets. So
Yeah.
I think we generally see eye to eye on that. I don't think anything else. Again, given the magnitude of this bank stress that we're seeing, I don't think retail sales is going to get a lot of attention, but it should hang in there. Remember, that's nominal. It's not inflation adjusted. And then the housing data, people expect housing data to be weak because of rates, right? Before mortgage rates recently came down, they went up a lot. So there's no doubt the housing data continues to be kind of tepid. So that shouldn't surprise anybody. And then the University of Michigan inflation expectations, I think, might be interesting.
And leading indicators as well.
And leading indicators, yes, which are affected by the markets. So maybe, that's already signaling recession. The bank failures do marginally increase the odds of recession, but maybe that'll get the Fed to pause, kind of seeing collectively all of these indicators weaken just a little bit while the banks are having problems at the same time. So we'll see. It's going to be one of the most interesting Fed meetings of certainly, I think, my career, maybe your career, Quincy, which is
absolutely
very hard to call. So
very difficult. And we have earnings this month. I know a week, but by the way,
yeah,
yes, Lennar, one of the I think it's Dollar General, and we also have FedEx. And I think also Adobe. So, you always say that the earnings period is over, and then you always have these names after because of the calendar. But that should be interesting as well.
Yeah, absolutely. Market didn't like Oracle's results too much. That was another big name that just reported. So we'll start talking about earnings season in a couple of weeks because it's not far away, and certainly the earnings season for the banks will be especially interesting. So with that, let's go ahead and wrap. Let's see if I can get to my closing slide. Hey, there it is. Thank you, everybody, for joining.
Thank you.
Really appreciate you tuning in. Thank you, Quincy, for on this complicated. It's a really complicated situation. It's a challenging environment. But we'll get through it, and certainly we'll continue to keep you updated on the situation going forward. So we'll be back with you next week. See you then. And everybody have a wonderful day.
Thank you so much. Bye.